Hello and welcome to Gold and Silver Assets. It's Sunday the 24th of May 2020. In today's talk I'm going to be talking about what I consider may be a coming stock market illusion. Now this is a subject that I've been mulling over for a while now, and over time my opinion on this has changed, and it may well change again as things develop. Some of our viewers had asked about the stock market and about the inflation-deflation debate, and I recently been reading a book about what it was like living through the Weimar hyperinflation. And while reading that book, there was one interesting observation about the stock market that may help inform us. So let's start by looking at this chart, which is of the S&P 500 dating back to 1872. And I think you'll all agree this looks pretty impressive. However, I don't believe that charts like this tell us the whole story with regards to individual investors and their gains and returns. So the first thing that I wanted to point out is that stock indices don't necessarily reflect what's going on in the economy. And we have seen some excellent examples of these recently. The other thing is that these indices don't reflect the performance of individual stocks within the index. The charts also don't account for dividend yields and what's the effect of reinvesting returns. Another big thing is taxation, which can occur at various points during the trading process. So, for example, in the UK, there's stamp duty to be paid when you buy stocks. There may also be a capital gains tax on any profits, and some countries even have an annual tax for holding foreign stocks. There are also fees to consider, such as trading fees. There are some fees for actually holding the stocks, as well as fees on foreign exchanges if you're buying stocks in another country. And in that situation, you've also got the foreign currency fluctuation risks that are associated with it. But the big thing that very few people speak about is the actual purchasing power of your gains. And it's that aspect that I'm going to discuss today. So we'll start with this small study that I thought was interesting. I recently came across this, and this study basically looked at the after inflation return for each month between 1871 and 2010. And the authors found that when the annualized inflation rate for the month was below 5.3%, the real stock market returns were positive. However, when it was above 5.3%, the real returns were negative. And they said that this relationship held up for over 140 years. Historically, the monthly annualized inflation rate has been above 5.3% for about a third of that time over the past 140 years. So if you were to look at the chart of the S&P 500 during the inflation that occurred in the 1970s, you'll see that the index was moving sideways with a kind of upward slant. But according to this study, the real return was actually negative over that time, meaning that the rise in the index was an illusion. So let's look at a modern day example. So if you were to look at this chart, anyone who invested in 2013 appeared to do exceedingly well. And if you look more closely, you'll see that this is the chart of the Argentinian stock index. Now we know that in Argentina inflation is running high. So the question is, how real are these returns in terms of purchasing power? A way of reasonably comparing things is to index these figures to a specific time point. So I've indexed to 100 in 2011. So in this case, the index CPI in Argentina is now 556. Now I don't know how accurate the current inflation figures are, but the officially reported figures for this year have been around 50%. My intuition says that all government inflation figures are likely to be underestimated. I've personally spoken to someone who's lived in Argentina over the last couple of years, and he was telling me that certainly day-to-day expenses had doubled in the year that he was there. And so that doesn't quite fit with the reported inflation rates, but I don't know. I haven't actually been to Argentina myself. So I would be very interested to hear from anyone who does live in Argentina and what their views and estimates are for the actual inflation rate there currently in terms of their day-to-day lives. When I indexed the stock market, that came to 1,100, which suggests that actually it was a good move to invest in the stock market if that inflation figure is in fact correct, and you would have gained in purchasing power. However, if we look at gold, we can see that outperformed everything. And I think there's no doubt whatsoever that gold has not only maintained but actually gained in purchasing power over time. Here's a chart showing the Caracas stock market returns for 2015. And this shows how apparent returns can be distorted depending on how it's measured. So in this chart, the kind of grey-green line shows the index price when the official US dollar exchange rate is used. And this is compared to the real rate shown in blue. So I presume that's the black market rate for US dollars. So, as you can see, one of them shows a very good return, whereas the other shows a loss. And I've shown this example from Venezuela before. And if we look at the stock market chart, although it looks great, when we compare it to the wholesale price index, we can see that actually the returns are losing purchasing power quite substantially. This contrasts with gold, which has much greater purchasing power. And taking the historical example of the Weimar Republic over 2 years, we can see that the index CPI went from 100 to 10 with 9 zeros after it. When we look at the stock market priced in marks, that's shown with the black line, that seems to only just keep up with CPI. However, when priced in terms of US dollars, it actually lost purchasing power quite significantly. And for comparison, both gold and silver did very, very well. So gold was actually at 100 with 9 zeros after it. So far, we can conclude that during inflation, the stock market returns may or may not keep up with purchasing power. However, gold probably always maintains or even increases in purchasing power. And I'm certainly not aware of any examples where gold has lost purchasing power during a time of inflation. That brings us to the question of what may happen with the S&P 500 in the longer term. Now, I used to think that we would get a drop to below the 2008 levels. However, such a drop, I think, would only be plausible in the presence of free markets. But remember that a lot hinges on the stock market, and many large institutions such as pension funds and insurance companies are heavily dependent on it. So drops like that would mean that all of them would go bust and there'll be absolute chaos. So I therefore think that central banks will pull out all the stops to prevent such a large drop. The big question is, how effective will those interventions be, and at what point will the effect of those interventions kick in? I don't have the answer to those questions, and I don't think anyone actually knows for sure, but I'm just going to speculate on some of the possibilities. So this is a chart of the S&P 500, but instead this is on a logarithmic scale going back to 1927. And we can draw a trend line that has had 4 touches historically. And so my rule is that while we are in an uptrend, we have to assume that the trend will continue unless we have an evidence of a trend break. So if this red line holds, then the lowest we can expect the S&P 500 to go would be at the 2007 peak kind of level. Looking more closely, that would be at around the 1600 mark. Another alternative would be if we were to join up the previous lows that we've had recently, and that would lead us to the 2016 peaks, which may act as support. Now, I don't know exactly when the turnaround will occur. There are some who believe that the turnaround has already occurred, but I'll discuss that a little bit later. Whenever the turnaround does occur, I believe that it will be central bank intervention that will drive prices higher. And I wouldn't be at all surprised to see levels of over 4,000 at some point. But remember, that won't necessarily be a good thing. Next up, the market update. Before we start with the market update, I just wanted to cover a few things just to make sure we're all on the same page. So I wanted to just cover what this channel does not provide. So first of all, you'll notice that I don't provide trading signals. I don't tell you about entry and exit positions. I also don't discuss risk management. So for example, position sizing and stop losses. And remember, these are huge parts of the trading strategy. Now, I am thinking of doing a series in a couple of months' time, if there is interest, which covers some of my thoughts on these topics. I also don't provide investment advice. I'm interested in precious metals, but that is something that I'm interested. It might not be interesting to you, or it might not be suitable for you. I also don't provide predictions. My name is not Mystic Meg. If you're looking for accurate predictions, well, I think you need to go and find a psychic. I'm certainly not a psychic. And I don't own a crystal ball. If you're looking for someone with skin in the game, I do have skin in the game in some aspects of what I talk about, but not all. So for example, I'm not involved with the S&P 500 or any of its components. I don't even trade the GDX. The reason that I talk about these charts is that some have requested it. So don't expect me to have skin in the game for everything that I discuss. The other thing is that I'm not responsible for your mistakes. Your mistakes are your own, and I'm unable to take ownership for your mistakes. I'm also not an emotional punch bag. Sorry. The other thing that this channel doesn't provide is Razzmatazz. The other thing that I wanted to comment on quickly was comment etiquette. So the things that I like and impress me in the comments are humour. Humour's great, and if you can provide it, thumbs up to you. Encouragement. So of course, everyone loves positive comments, and actually if all I received was negative comments, I wouldn't be motivated to keep making new videos. So thanks for all the encouraging comments. Constructive criticism is very welcome. So any criticism that is actionable and specific, great. And you know, we've had some people who have made comments in the past, and I've taken those on board because I can see their point of view and it's something that I can take action on. If we have some vague criticism like, oh, you're rubbish, well, it's first of all not very specific, and there's nothing I can do about that. Unless you actually give me a solution. Reasoned debate. So I don't expect everyone to agree with each other or to agree with me. I don't know anyone who's right all the time, and I think that there are multiple points of views that should all be taken into account. And so reasoned debate is very welcome here, particularly if you can provide some more background to the reasons for your point of view. I also really enjoy hearing from personal experiences from people all over the world. So we've had people who have described trades that they've made, and I applaud anyone who makes a profit. Good on you. And we've also had experiences of people who have had trouble getting hold of precious metals, for example. And so those kinds of things are very, very informative. So keep it up. And I also welcome ideas. As I said, I don't know everything, and it's always good to hear new ideas and new approaches to things. What offends me in the comments is, as I said earlier, unactionable criticism. So criticism that's completely vague and doesn't have a solution to it. Being blamed for your problems and your mistakes. So I believe that everyone has to take full responsibility for their own actions. Some people wish to transfer that responsibility, but they have to do that knowingly, and the person that they transfer those responsibilities has to accept those responsibilities. I haven't accepted responsibility for anyone here. I'm simply airing my views and my opinions, and that's as far as it goes. The use of foul language doesn't seem particularly appropriate for a channel that talks about precious metals. So unless it adds some comedy value to what you're saying, I think it's a bit pointless. It usually shows a lack of vocabulary to express yourself, and usually it's the language of drama queens. So I'm not interested in any of that. And the other thing that offends me is emotional outbursts. When you're looking at the markets, emotion is actually what fuels a lot of what goes on in the markets, and it's often those who are able to be emotionally detached who I think tend to be the more successful traders. So for me, emotional outbursts are just merely a distraction from the goal. The goal here is to make a profit in the end of the day. So those are my personal views. For those who don't like it or disagree, I'd politely ask you to move on, because there's plenty of other YouTube channels out there that can meet your needs. So let's move on to looking at the markets. And this is the S&P 500 on the daily scale. And I wanted to start by talking a little bit about the vocabulary, particularly the words right and wrong. So I'm going to start with an example of a person who, say, bought the S&P 500 a couple of years ago when the levels were much lower, and then when prices got to around here, he started to get a little bit nervous and sold here. And there would have been a lot of people who'd have been saying, oh, you were wrong, it's going up, it's going up. So on the short time frame, yes, he was wrong. However, this person, remember, is looking at longer time scales, and so if we do expand our time scale, you can see he was very right. Let's take another example of someone who took a leveraged trade and bought at this level here and was leveraged long, and of course price shot up. But of course then it turned around, and when this gap occurred, he decided that he should sell here. So can you say that he was right or wrong? Well, he was wrong in terms of the longer term long position. So if he was expecting prices to go up here over a longer time scale, yeah, he was wrong. But then let's say he sold over here, then he was right. He did in fact sell down here, but remember, he avoided this huge loss, and with leverage he would have been absolutely incinerated. So he was right to sell. And for each chart and each trader, there are so many scenarios that can play out, and so I don't believe that the words right or wrong should be used when it comes to the markets, because it's totally individual. Remember, your time scale is everything, and your trading strategy is going to be personal to you. Now, this whole lemming analogy seems to be a bit like Marmite. People either love it or they hate it. I'm still sticking by this. I still believe that this is just a bear market rally, and I'm just going to go into my reasoning for thinking so. So first of all, in the bigger timescales, I believe that we're in the start of a downtrend. Certainly, we haven't made any higher highs so far. Secondly, if you look at just above the 3,000 level, going back here, we've got an area which seems to be resistant. So it's not exactly at the 3,000, it's kind of just above. And so I would expect that to remain as resistance going forwards. So we may still get some further up moves, that's entirely possible. But I would only change my mind about the bearish scenario if we go above that level, in which case this is kind of like an air pocket and it will blast through there. On the shorter time scales, we started off with this upwards trend, but now we seem to be moving in a more sideways price action. So to me, this is looking a little bit on the weaker side of things. The other thing that we've talked about is this wedge pattern, which is in most cases bearish. But remember that I've said that wedges can play out in a number of ways. So if we have this wedge here, the ideal way is a breakout downwards and to go straight down, or it can break up and then retest the trend line before making its downwards move. And sometimes they actually pop out the top before moving down. And the lowest probability for these is for them to keep moving up and blast upwards. Now remember, I said the lowest probability. That doesn't mean that it's not possible. The next thing I want you to look at is, I'm going to show you a chart in the next slide, but before we do that, just draw your attention to these bounces here, which acted as resistance. Price blasted up through there and then it dived down for a huge decline, and this decline happened over about 3 weeks, and this was actually a historic drop. It was the fastest such crash in history. And then on the way down, you can see that we've moved down, a little bounce up, and then the big move down here. We've then retraced, and in these scenarios, it's usually between 50 to the 62% Fibonacci levels. So this is the chart of the 1929 crash. And so if we look here, we can see that price moved down, had a little bounce up, and then we had the big move. And remember that this crash happened over around a couple of months based on this chart. Then we've got this up move here, and if you look closely, this does have that wedge shape to it, and in this case it popped up the top a little bit before making its decline, and this was around a 50% retracement. So does all that sound familiar? And the other thing is that we've got this grinding decline beyond that. And as I was mentioning in the first part of this video, I'm not expecting prices to drop, 80% like they did in 1929. I think things are likely to be different purely because back then, although they did have some stimulus measures, they were limited due to the gold standard. Right now, we're in a point in history that's never occurred before, where all currencies in the world are fiat and there is unlimited power for printing. And we don't know when that power is going to kick in to reverse this grinding downtrend that we see. And the other thing, this is just the same chart, but it actually moves to an earlier stage. And again, this is the retracement that I've explained here. And if you look here, that was actually resistance in the bouncing area that we saw earlier there. So it's not exactly the same, but there are similarities. And the other thing I would suggest that is useful is to look at a lot of other charts where you've had a rapid large rise in prices followed by a crash. And it's really common to see this pattern where you see this crash, a strong bounce up, and then a grinding decline. There's loads of examples around out there. And so that's what makes me think is going on with the S&P 500. So I've given my reasoning for why I think a downwards movement is coming. Now, there may be people who disagree with that and they think that we've got a greater bull run coming, and that may well be the case. The reason that's usually cited is manipulation, but I would say that that's not reason enough to bet on that. The reason I say that is that this so-called manipulation has been going on for years now. So why was that drop that we had recently allowed to occur? Surely they could have just, gone in and stopped that from happening. And do we know that manipulation can stop another drop? Will there be that lag that we've seen between the drop and the reaction to the drop? So moving on to gold in US dollars on the daily scale, and we've been talking about this symmetrical triangle, and price had broken out above that, and then I had spoken of the possibility of a retest of that upper trend line. And remember, if we're using this pattern, then the target would be 1800 US dollars. Certainly the fact that price bounced off of this upper trend line suggests that the target is still in play. We remain in an uptrend, we have higher highs and higher lows, and so the assumption has to be continued upwards move. Remember that we are in an area of entanglement because back in 2012 there was a lot of price action in this area with a lot of sideways movements, and so that will affect where we go here. And as I've said before, I'm doubtful that we're going to blast through that 1800 level on the first go. I think it's going to take more than one go to get up through there. This pattern would be a failure if price dropped below that upper trend line, and then the next support line would be this line here at around the 1680 level, which is the top of the channel that we'd previously drawn. And just a quick look at the GDX. So after this sharp decline over here, we've had prices rising in what appears to be this upsloping channel, and right now we are right at that lower trend line. The question is, will that line hold? Now, it is entirely possible that that will hold, in which case we can expect price to go back up and try and make it up to the top of the channel. But I'm just still a bit wary about the GDX, as this price action is still looking a little on the weak side. If we do break down below this channel line, then price may well bounce off of here, because this has previously served as strong resistance for around 7 years, and so this could be potentially strong support. And any drops below this would suggest that this has been a fake breakout, in which case price would be looking to close these gaps that have previously been around. And as I've said in previous videos, it's actually the general stock market and what that's doing that makes me a little bit nervous about these mining stocks at the moment. Now, we did have one viewer who asked a question about whether the idea of gold miners being correlated with the stock market in general is actually a valid one. And so actually that's too long to answer, and so what I'll do is bring up a video of that coming up at some point. So thanks for listening, and sorry about the little rant in the middle, but I felt that it had to be said just for the minority. I know that the vast majority of my listeners and commenters are actually very sensible, intelligent, smart and funny. So keep it up. And if you like what you heard today, don't forget to like and subscribe. It keeps me motivated. That's all for today. See you next week. Bye.